The 2026 housing crash isn't a forecast. It's here. December 2025. And it's not coming from where you think. This isn't about interest rates or inflation. This is about artificial intelligence destroying the financial foundation of America's wealthiest professionals. High-earning tech workers who drove housing prices to insane heights are being replaced by AI. And they're losing their homes. In Seattle, where Microsoft eliminated 15,000 positions, home prices collapsed 14% in 6 months. These are software engineers making $300,000 a year. And AI made them obsolete. By mid-2026, entire housing markets built on tech wealth will implode. This is the 2026 housing collapse. And it's already started.
Microsoft has eliminated over 15,000 jobs since May 2025. These aren't typical layoffs. These are AI-driven replacements. The company is investing $80 billion in artificial intelligence while cutting 7% of its workforce. CEO Satya Nadella acknowledged the contradiction, calling it the uncertainty and seeming incongruence of record AI spending alongside massive job cuts. Here's what he didn't say. 30% of Microsoft's software coding is now done by AI, and that percentage is accelerating. Over 3,160 Washington state employees terminated. Software engineers comprised over 40% of layoffs. These were professionals earning $250,000 to $400,000 annually. AI replaced them. Amazon followed the same playbook. They cut 14,000 corporate positions, targeting middle management that AI can automate. CEO Andy Jassy was blunt. As we roll out more generative AI, we will need fewer people. The tech industry saw over 100,000 layoffs in 2025. But these weren't renters. These were homeowners who bought million-dollar properties at the peak. Now, they're forced sellers. Seattle's housing market is in free fall. Prices plunged 14% since May. The median dropped from $831,000 to $715,000. That's $116,000 lost in 6 months. Tech workers who purchased in 2021 to 2022 are underwater. They owe more than their homes are worth. With mortgage rates above 6%, they can't refinance. They're trapped. Inventory surged 27% year over year. Homes sit 75-plus days. Over 30% of listings have price cuts of $50,000 to $100,000. The east side suburbs, Bellevue, Redmond, Issaquah, show the sharpest declines. Rents fell nearly 10% year over year. For every layoff, 10 coworkers lose confidence. Spending contracts. Home purchases get canceled. The ecosystem built on tech wealth collapses. What happened in Seattle is spreading nationwide. San Francisco saw 9% decline since May. Austin's inventory is up 38%. Raleigh-Durham watches AI automate research functions. Phoenix, Arizona remains ground zero. Inventory surged 44% year over year to 23,000 listings, highest since 2017. Price per square foot is $271, down $21 from peak. Homes sit 74 days. 31% of listings have price reductions. Sellers accept $10,683 less than asking on average. Outlying areas are littered with half-empty subdivisions. Builders offer rate buydowns to 4%, closing credits, and landscaping just to move inventory. Las Vegas shows inventory more than doubled. Homes sit 90 to 120 days. Over 40% of listings have cuts of $50,000 to $150,000. Median values fell from $460,000 to $380,000, a 17% collapse. Analysts expect another 20 to 30% decline through 2026. Boise is the boom-to-bust poster child. Prices peaked at $575,000, now $430,000, a 25% collapse. Homes sit 140 to 150 days. Monthly payments exceed $3,800. Foreclosures rising. Florida faces insurance, climate risk, and overbuilding. Tampa, inventory up 55%. But the crisis is insurance. Premiums doubled, many exceeding $9,000 annually. Combined with property taxes and HOA fees, ownership became unbearable. The Airbnb market collapsed. Thousands flood resale markets. Cape Coral, prices shot from $230,000 to $470,000, 104% increase. Now at $380,000 and dropping. New builds sit empty despite $60,000 plus discounts. Over 50% of homes have deep cuts. Inventory tripled versus 2022. Retirees sell at losses to escape insurance costs. Seattle reveals the future. The market was built on one assumption: tech jobs are stable and endless. That assumption is dead. The Wall Street Journal documented former Microsoft engineers applying for barista jobs. Restaurant closures. Commercial vacancies spiking. Seattle faces a $146 million budget deficit. Amazon and Microsoft account for 40% of regional workforce. But this is just beginning. Jassy expects workforce to shrink due to AI. Analysts predict Microsoft could eliminate 10,000 jobs annually. That's 10,000 high-income households per year. And it's spreading. AI targets finance, healthcare, legal services, consulting. The white-collar class that bought expensive homes is next. When a tech worker loses a $300,000 job, they exit the housing market. They become renters or relocate. Businesses lose customers. Tax revenue declines. Quality of life erodes. Q1 2026. Seattle, San Francisco, Austin. See distressed sellers. Prices drop 5 to 10%. Phoenix, Vegas, Boise. See continued declines. Foreclosures pick up. Q2 2026. AI layoffs expand beyond tech. Financial services, consulting, healthcare cut professionals. Boston, New York, Chicago feel pressure. Bubble markets fall another 10 to 15%. Summer 2026. Delinquencies spike. Banks tighten lending. FHA loans show elevated defaults. Q4 2026. National prices down 10 to 12%. Tech markets down 20 to 25%. Overbuilt Sunbelt down 30 to 40%. Housing enters sustained downturn through 2028. This isn't a normal correction. This is economic restructuring driven by AI. Eliminated jobs aren't returning. When Microsoft replaces an engineer with AI, that position is permanently gone. These were high-income households driving demand. When they disappear, local economies collapse. Tech hubs, Seattle, San Francisco, Austin, built on endless job growth. That growth is over. Sunbelt markets, Phoenix, Vegas, Boise, Florida, built on speculation and remote work. Both drivers are dead. Only diversified economies show resilience. Boston, New York, Philadelphia hold better. But even they face pressure as AI spreads. If you're a tech worker, understand your risk. If AI does 30% of work now, it'll do 60% within 2 years. Pay down debt. Don't stretch for housing. If you own in tech-heavy markets, watch the data. When inventory surges, that's your signal. Sell while buyers exist. If you own in bubble markets, accept reality. Phoenix, Vegas, Boise, Florida aren't recovering quickly. Exit while possible. If you're buying, patience wins. The next 12 to 18 months bring opportunities unseen since 2011. Wait for stabilization. Look at Seattle. 14% collapse in 6 months. Professionals with high incomes, until AI made them obsolete. The 2026 housing collapse isn't prediction, it's documented reality. Seattle proves what happens when high-income jobs disappear to AI. Phoenix shows speculation meeting reality. Florida demonstrates insurance exceeding affordability. This is just beginning. AI isn't slowing. More jobs eliminated, more forced sellers, more markets collapsing. By late 2026, carnage will be undeniable. Values down 20 to 30% in exposed markets. Equity wiped out for millions. The difference from 2008? Then it was subprime borrowers. In 2026, it's educated professionals who can't keep jobs. AI doesn't discriminate. It eliminates based on efficiency. When it eliminates a $300,000 salary, it eliminates the housing demand that salary supported. The 2026 housing crash isn't coming. It's here. The only question is how bad it gets.